Monday, July 8th, 2019, Maneco 64, home of alternative economics and contrarian views. So yesterday, Deutsche Bank, as expected, announced the details of its radical overhaul, as the FT calls it. I tweeted out yesterday and before that it's going to be their last chance saloon. Well, even the FT agrees. It says Deutsche Bank gambles on the last throw of the dice. So they announced the plans that they will they're planning to cut 18,000 jobs, mostly from investment banking, which is the biggest part, I would say, in the city of London and New York on Wall Street, probably in Frankfurt to some extent as well. And they're going to create a bad bank of 74 billion euros, which is more than was previously speculated upon. So this is what I will talk about today. It's fairly early here still. It's 7:23, so we're not seeing the Deutsche Bank stock trade yet. I think it starts at 8 a.m. But so before I go into Deutsche Bank and what I think is the underlying problem of Deutsche, not only of Deutsche Bank, but all the other significantly important banks, or SIFI, or too big to fail banks, right? So, as I said, it's 7:23. Right now, we've got spot gold up just over $4 at 1,403.50, 1403.50. Range has been 1392.50 to 1406. So gold's up about 1/3%. Silver's up about 1/3 as well, up 5 cents at 1504. High's been 1507 to 1495. I have had a look at the daily chart of gold, for example. I think we're consolidating. We've had a big move up, and the market is taking a rest. I've also seen some seasonal charts of gold from an article in King World News. And historically, from the end of July to like the end of the year is the strongest period seasonally for gold. So we might still see a little bit of consolidation, maybe even a bit more weakness in gold before it resumes its move higher. Who knows? So the stock market, the Dow is right now down 108 or 0.4% at 26,818. The high's been 26,940, and we've been as far down as over 200 points, 26,780. So S&P is down. S&P is down 12.4 as well, 29,7950. Nasdaq 100 future is down just under 1/3% at 77.97. The pound's unchanged, 125.28. Euro is down 4 pips, so virtually unchanged as well, 112.21. And the dollar is down 0.12% against the yen, 108.30. Dollar yuan unchanged at 689.60. WTI crude up 10 cents, 57.56. Brent unchanged, 64.11. Bond markets, the U.S. 10-year yield is down just under 3 basis points at 202. We saw a spike in yields and a drop in prices last Friday in response to the better than expected U.S. non-farm payroll numbers or jobs data. So Deutsche Bank, yes, there's been a lot of coverage of Deutsche Bank, especially on YouTube alternative space. I've been talking about Deutsche Bank since 2016, but it seems to keep going. It's like a zombie bank, right? But now I think this is their last chance. Even the mainstream media is saying so. FT, as I said earlier, says Deutsche Bank gambles on the last throw of the dice. So as I said as well yesterday, and when I tweeted, last chance saloon. The problem for Deutsche Bank is a problem for all the other too big to fail banks, and that is their exposure to derivatives, be they over-the-counter derivatives or exchange-traded derivative or as the Office of Control of the Currency in the US calls it, centrally cleared derivatives contracts. And yeah, it was the major, one of the major, well, it was the Achilles heel of the whole system back in '08 when the whole system almost imploded. And why was that? Well, because when Lehman's was let go and collapsed, Lehman's had massive exposure as well to derivatives. The notional amount, a lot of times you talk about the fact that it's a huge notional amount, like it was over $1 quadrillion during the '08 crisis, or 1,000 trillion. But the bankers always say, oh, it doesn't matter because the long and shorts net out and the notional amount doesn't come into play, right? But it does come into play when the counterparty fails, right? Because then that whole notional derivative amount comes into play, and that was the problem. That's why they had to bail out AIG. AIG had an arm in London called AIG Financial Products, and they'd been writing credit default swap insurance, which is an over-the-counter derivative for all these major too big to fail banks. So that's the problem. There's talk that Deutsche Bank, I've heard many amounts from 40 trillion euros to 70 trillion euros of derivatives, but it's not really, I'm not really sure people know exactly. It's not a public number. The other thing people need to understand, that derivatives are kept off balance sheets, so they're not even on the balance sheet. That was one of the first things that I thought was strange when I started working in this business back in the late 80s, early 90s as well. Started learning more about derivatives, and one of the main things I was told is that they're off balance sheet, so they're not on the bank's balance sheet. So if you look at this plan for Deutsche Bank, it's all focused on its balance sheet, what they're going to do with its balance sheet. But they never talk about the fact that they have a huge derivatives position, right? So, and I think one of the reasons as well why the central banks are coming back and going full throttle back to cutting rates, starting to do QE again, it's because they know that the banking system is in trouble, and Deutsche Bank is the tip of the iceberg, I would say. One thing I'd like to show you is the OCC in the US, from their website, their latest quarterly report on bank derivatives activities. So here we go. So it shows here, JP Morgan Chase Bank NA, total notional derivative amount, 71,547. That's billion, by the way, so it's 71.5 trillion. So you thought Deutsche Bank had a lot of derivatives? Think again. Citibank, 45,850, or 45.8 trillion. Bank of America, 20.7 trillion. And the one that is really, in my opinion, needs to be careful, Goldman Sachs, almost 40 trillion in derivatives, even though it's a much smaller bank than the ones above it. HSBC is in there. They've only got 5 trillion. Wells Fargo, 10 trillion. So the major too big to fail American banks, you can see there, have almost 200 trillion. It's not billion, it's trillion in derivatives. So you can see why Deutsche Bank is really important, because if this plan they have to extricate themselves out of this trouble, which is basically a derivatives problem, and you don't hear that too much when you read in the mainstream, that could spill over to all the other banks, too big to fail banks in the world. Are they going to be able to, the powers that be, to keep Deutsche Bank going? Yes, they could. Buy all their assets, all their crappy, toxic derivatives. The ECB could do it. The Fed could do it indirectly. And from Deutsche Bank's American counterparties. And how could they do that? Well, through more QE. But there is a consequence to all this QE and money printing, and that is the debasement of the currency, not only of the euro, but of the dollar. So before I finish here, let's just quickly read through what Deutsche Bank is doing. According to the FT, it says Deutsche Bank has unveiled one of the most radical banking overhauls since the financial crisis, closing swaths of its trading unit, cutting 18,000 jobs, and hiving off 74 billion of assets as it calls time on its 20-year attempt to break into the top ranks of Wall Street. I mean, 74 billion doesn't sound very big, does it? Compared to their 40 trillion in exposure to derivatives. The struggling German lender confirmed it would close down its loss-making equities trading business and shrink its bond and rates trading operation in a long-awaited announcement on Sunday afternoon. The axe will fall hardest on the investment bank, where the balance sheet allocated to trading. You see, balance sheet, the derivatives are not on the balance sheet, will be slashed by 40%. Job cuts will start first thing on Monday morning in London and New York, as I said, and 3 top executives have been replaced. The sizable workforce reductions will require uncomfortable decisions, Chief Executive Christian Sewing said in an internal memo to staff seen by the FT. So this is like the details here. Deutsche will create new bad bank dubbed a capital release unit, another euphemism there, comprising 74 billion of risk-weighted assets we spoke about earlier, equivalent to 288 billion of leverage exposure on the balance sheet. So still no talk about all those derivatives, right? And 288 billion is like a drop in the ocean if you're looking at 40 trillion in notional derivatives. The lender expects asset disposals will allow it to return 5 billion to shareholders via special dividends or share buybacks from 2022. Dream on. It says the new strategy signals a retreat from Deutsche's global ambition and its aim to be Europe's main rival to Goldman Sachs. Well, another interesting thing, Goldman Sachs has been one of the big buyers of Deutsche Bank stock this year. So I don't know what their game is. We will see eventually. So Deutsche Bank, just show you the Deutsche Bank chart, even though it's not trading at the moment. It did bottom below 6 euros. It was back in the beginning of June, and it has rebounded quite a bit, I guess, on kind of by the rumor. So we'll have to see later on if it's sell the fact, right? If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great start of the week. Take care. Bye.